All right. Hang on a second. Let me get a clock on this. Don't see how fast I can do this. It always annoys me, but it actually doesn't take very long, does it? 6:27:28. 30. Access to this webinar is for educational and informational purposes only. Consult screwed it up already. Consult the licensed broker or registered investment advisor before placing any trades. All securities in order to discuss and track and monitor virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing in this webinar website or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and only valid on that specific or identified date. Your results may vary. By accessing the webinar, you agree to hold email calls for any losses you may incur as a result of the information discussed in the media identified above. By accessing the webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. And that was, was that a minute? I think there was a minute. Okay. It's not bad. I don't know, it just annoys me. I guess I repeat the same thing over and over again. I hate reading things. I don't even like reading my kids. Thank God that's over. I do like reading my kids, though. I talk all the time, but reading is not my thing. I mean, I read myself, but reading, you know what it is? It's so slow, because it takes, my mouth is so much slower than my reading speed. Anyhow, what do you care? Let's see how the markets are doing. Dun, 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 dun. Oh, we're making money on natural gas. That's unbelievable. 5,100ths a day. We're now up $7,200 from the open. After all, it's from last week. It's the same trade. I haven't changed it. We're still long on natural gas. We're hoping to get to 220. All right. So if we're lucky, we'll get a nice little move up into like the 190 area tomorrow, and then we could probably hit $2 like next week, and that'd be freaking fantastic. And I'll tell you, from here we're only at 178. If we hit $2, that's still no, we're not at 178. Wait a minute, that's my average price. Sorry, we're at 185. So $2 is $1,500 per contract higher than we are now. So I'm projecting next week that we'll be up $22,000. That's what I'm projecting. So that means if you start now, I would recommend starting with 10 contracts because we're a bit high. But if you use that 185 line as a stop, you can still go long here. But you really have to use 185 as a stop. Notice we stopped at this. This is resistance number 2. Here's support 1, support 2, resistance 1, resistance 2. So we hit resistance 2, which is a great move for a day, and we bounced off it. Big deal. That's not unbullish. That's perfectly fine. Then you want to consolidate, and then hopefully tomorrow we break higher and we have higher resistances. Oil, on the other hand, topping out at 38. We should get current here. I just put out a top trade alert. Where are the top trade alerts? We have a button for them somewhere. Oh, there it is. That's a big thing. See Phil's latest top trades. Okay, so we have 2 top trade alerts, one today. We have never done a short top trade alert before. I don't think, unless we did TLT. We might have shorted TLT. In fact, I mentioned TLT here because it was part of the note. But, oh, by the way, a top trade alert, like here is Wednesday's post, right? So here's the public part, which is only that big. It's still a pretty big post. Then here's the rest. See where my elevator is here on the side? So that the rest of it is what happens after the bell and until 1 o'clock. So these are all the other comments we've been making and talking back and forth. So this is our second top trade of the day. We did a whole review of the short-term portfolio already in member chat, which we're in love with. It's so great. Of course, we're in love with it. It's up 400%. And we are very pleased with our positions, though. There was really nothing we were upset about. We had a fantastic move last week with CNG. Oh, wait, let's stay on topic, though. Where were we? We were going to talk about Chevron, right. Okay, so see, here's how a top trade starts. We talk about something in member chat. Then you see where it says, oh, you can't see it here, it says review top trade. See where it says create top trade? So when I make a comment and I think that the trade should be a top trade, then I hit this button and it converts it into a top trade alert. See, and then then it makes a new post to me and I have to clean it up. But basically that's what happens. So all top trades, people ask us that sometimes. They say, well, what, do you get this stuff here and do you get this stuff here? When you're in member chat, you get everything. This is where all things start. So unless it's a premium only comment, which I don't make a lot of, it's for high net worth people or our institutional investors and high net worth individuals, unless it's like a premium comment where we're talking about here's a block trade or buying a ton of this or a ton of that, which we hardly ever do. The last time I did one was Win Casinos. So unless it's something really major, it's not going to be a super premium trade. The difference between premium and basic chat is really the premium people see everything a lot faster than the basic people do. But either way, the fact is if you're a chat member and you're in the live chat membership, you will see all this stuff. And this is what we have. So this came out of the chat. It was 12.54, and by the time it became a top trade, it was still 12.54. So it got, it basically got published almost at the same time as the top trade. Okay, not all trades become top trades, but this one just happened to. And then when you click on top trade, you essentially see what the comment people see, except it looks more like an article. And I was pointing out, here's my thing about Chevron, okay? Because it's back at 95, and let's take a look at Chevron. Oh, that's the wrong one anyway. I didn't want to see that. So Chevron is blasted back to 95. It's pulled back a little bit already. But it blasted back to just under the 95 line. See here where it blasted up to 96 and then said, whoa, that's a big mistake, and it went back down? It's a worse mistake now. Oil, and here's the multi-year chart. Okay, so they topped out like 2 years ago, they were barely at 100. And back here, they were still $99, under 100, okay? So, meanwhile, oil, which they sell, and see what I was pointing out in the top trade alert, oil, 64% of their frickin' business is oil. Okay, so if you look, this is just logic. So let me say, oh, well, how's the oil business doing? WTIC, that's what they sell, oil. All right? And, oh, dear, oh, look at that. Oil was $100 when they were last at $100, and now it's $35. That's not good. And you say, oh, well, okay, how about their natural gas business? That's 15% of the company. And then you look up natural gas. Nope. Then we look up natural gas by spelling it correctly. There we go. And now you say, well, when they were at 100, natural gas was $4, and now it's $1.80. That doesn't sound good either. Then you say, okay, well maybe, okay, so you try to think that traders are rational somehow, and you say, well, maybe there's a reason that it went up, and I looked at the news. Okay, let's go through my whole thing. I mean, I went through all these steps when I was talking about it, because I was saying, maybe I'm nuts. Maybe I'm not seeing something really urgent happening. So I looked through the news. Why are they up 5% today? And it says Chevron stock prices raised at Credit Suisse. Raised to what? Let's see what they raised it to. They raised it to 96 from 84. But they're still neutral on the stock. Well, that's not really a big deal. They're already at 96. There's no other news particularly today or yesterday that should have moved Chevron. Here's the thing that says Chevron can outperform Exxon by Barron's, who I don't think they've been right this year about anything. Oh, I didn't mute people, sorry. Hang on. I hear you.
You are now muted.
All right, there we go. What was I talking about? Oh, yeah. So no particular news. So then we go to the financials, and I don't have this thing on this computer, but so we go to the financials, and we say, well, let's see. 2 years ago, they were doing $200 million in revenues. $200 million in revenues. Now, they're doing $100 million. Well, maybe they're making a lot of profit. No. They went from 19 million to the billion. These are billions. Wow. Oh, I'm sorry. This is billions. 199, such a big number, it doesn't seem real. 199 billion in revenues. They've lost 90 billion of those revenues projected this year. 19 billion in profit. They've lost 16.5 billion of the profit. Cash flow, negative 1.5 billion, negative 2 billion got worse, negative 5.3 billion got even worse, and now we're going down another 25-30%, and this is going to be a much worse number. It's going to be like minus $10 billion. Why would you pay the same amount for this company that you paid for this company or this company? Makes no sense. They used to make $15 billion. From there you say, oh, well, maybe they'll come back, whatever. Do you know how hard it is to come back from negative to plus 15? It's going to take them the same 3-year cycle just to claw back to where they were. And that's assuming oil ever comes back to these kind of numbers. So they got an upgrade, which made no sense, but, you know, since an upgrade triggers a whole bunch of computer buying and a whole bunch of idiot buying where people just jump in and follow an analyst, you know, they go, oh, somebody upgraded Chevron, let's buy Chevron because I'm looking for cheap energy plays. This is not a cheap energy play. This is a very expensive energy play. This is a company that makes $3 billion a year, and we're being generous, but let's say that they make $3 billion a year. Here's the thing. Well, I mean, put it simply, they're making $1.50 a share, and the share prices are $95. So we take $95 divided by $1.50, and that's a PE of 63 for an oil company. That's freaking insane. Okay, and it's insane to the point where it's probably not sustainable. So given that we have this wonderful little pop and all the options got cheap and blah, 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 so my thought on that process was, so I'm saying, wow, so here's me making my case about cash flow and revenue and blah, blah, blah. And then I say, well, okay, we have to short them. This is, how could you need, I don't like doing a short on something like this because the energy is so hard to predict, but this is, come on. You know, it's like, please. It's like, you know what it's like? It's like me being on a diet, which I'm very bad at. It's like me being on a diet, and then there's like a hot fudge sundae bar at a party, and I'm like, what am I going to do? Not have it? It's like my favorite thing is hot fudge. So you know, it's like, you know, so some things are just dangled in front of you, and you can't resist it. Okay, and this is one. So in the short-term portfolio, what we're doing is we're adding, we're selling 10 calls. Again, we hardly ever do this, so it's like a rare thing. We're selling 10 calls at $92.50. All right, the April $92.50. So about a month or so from now, we're selling $92.50 calls. So I think it'll be below $92.50 again for $3.90. If I'm right, this becomes free money. We collect $3,900. We're going to take that money though and turn around and buy 20 of the April 90 puts, 90 here. So what I think is going to happen is not only are we going to retrace this one-day gain, but I think that when push comes to shove, coming into earnings, they're going to come back down to this 85 range. And that will make these 20 puts worth about $10,000. And we're paying net $500 for the entire spread. So we'll make, if all goes well, we'll make $9,500 in about a month. That's the goal of this spread, on a $500 cash investment. So that's why that's a top trade. That's what top trades are all about. You know, we try to pick the ones that have a good, really good percentage. Ones I feel good about for the kind of trader top trades are. You know, our top trades, you're not participating in the chat. The top traders don't even know what we're talking about in the chat room. That's not a chat membership. What it is, though, is we just send out on a weekly basis, usually once a week. I think once a week, twice a week, almost never 3 times in a week. And we'll send out an alert, which goes to their email, and it sends a page to their text page. I'm so old. It sends out a text. And it just has it doesn't even have the quote. Basically, the page says, you know, hey, there's a short on chevron, so click on the link. So that's what we do for the top trades. Now, other top trade for the day. So I love this trade. Now, to me, this is such a stupid thing. We'll see how it goes in the coming weeks. So our other top trade this morning was Apple, because Apple went back down to 100. It's back at 101 now, apparently. Let me see. Apple, yeah, 101. Okay. So it's back to 101, but Apple was down here this morning. And I'm like, oh, that's too low. You know, I'm sorry. 100 is just ridiculous. So I said, Apple's taking a surprisingly big dive, which wasn't that big, but it was, at the time we were looking at it on the short-term chart, here was this dive. It was really only $1.50, but I was just like, whoa, what the hell? So Apple dropped $1.50. I saw again, I see something happen. I look at the news. I don't see any particular good reason for it happening. And so I say, you know what? We might never see 100 again. If everything goes well on the upcoming, they're rolling out products. I don't know when, next week or something like that. You know, when they announce new products and they talk about their sales and whatever, you may never see $100 again on Apple. And we know we love them. So I'm still being conservative with selling 5 of the 2018 $85 puts for $9.20. That gets you $4,600 in your pocket. So you're promising to buy 500 shares of Apple for $85, which is, you know, obviously 15 below the current price. So that's your base promise. But then we're buying 10 of the $90 calls. Now they're already $10 in the money. We're buying the $90 calls in Apple to the 100. That's not bad. All right, we're buying 10 of them, though, for $20. That is bad. That means we're net paying $110. But we remove that by selling 10 of the 110 calls for $11.30. This is what I mean when I'm talking about being the house, when we talk about how to be the house and don't be the gambler and sell premium. What are we doing? See, we are buying more premium than we're selling. We're buying $20. We're buying $20 of it's not premium though. Only $10 of it is premium. $10 is the intrinsic value of Apple. So we're buying Apple, which is at 100, and we're buying a position for 90. But we're spending $20, right? But we don't want to spend $20. I don't want to spend more money than Apple's worth. So instead, I find a sucker who's even more aggressively bullish than I am, and he's going to buy for me the 110 call. So I'm betting Apple's going to be, I think Apple's going to be over 90. And he's going, oh yeah, I think it's going to be over 110. And he's willing to pay $11.30. So the net of the spread for us is $8.70. So we pay $8.70. So that means technically I'm in for $98.70. And I make all the money that Apple makes from $98.70 up to $110. Over 110, it's a wash for me because I can't, you know, whatever I make over 110, he gets paid. So my max becomes 110, but I'm willing to accept the max of 110, especially because I also sold the puts. So our net on this trade is $4,100, and the spread is a $20,000 spread. $20 times 1,000 options. So our spread is a $20 spread. And we're going to make $20,000 if all, not make, we're going to collect $20,000 if all goes well. That's a $15,900 profit in 2 years. A wonderful trade. And this is the way you want to trade it. But this is what I mean by being the house, because we're taking bets. I'm taking a bet from one guy who thinks Apple's going to be over 110. I think it'll be over 110 too. But he'll pay me to say it. So I won't pay to say it's over 110, but this guy will. In fact, he doesn't even make any money until Apple's at 121.30. He thinks we're going to be up here. And I don't disagree. I think he's probably right. It might even be actually a good bet. He might make more money than we do if it's at 150. But I don't care because our bet's easy. Because we're selling the premium. We're not buying it. So we end up paying net $4,100, which is $410. So I'm at $94.10 is our entry price on this trade. Anything over $94.10 is profit for us, all the way up to $110. That's our profit zone on this trade. And that's what being the house is about. Let other people take the risk. I have another guy here we sell the 85 puts to. He thinks it's going to be below 85. He thinks it's going to be way down here. If we're anywhere in the middle, we make money off of both guys. If we're up here, we don't care because we can't lose to this guy. We can lose to the 85 guy. Anything below 94.10 and we're losing money. Okay, so below 94.10, we actually are in the red and we could lose money. But we won't lose more money than the person who buys Apple for 100. Right? Anybody you buy Apple for 100 and you hang on to the stock, you're going to do worse than we will. So there's nothing negative about playing the options and everything positive. We have incredible leverage. We use very little cash. We don't even use much margin. And it's a fantastic position. It pays $15,900 back on $4,000. That's like, almost 4 times back. I'm sorry, 4 times profit because it pays back $40,000. Let's see if anyone has a question about that stuff. All right, so back to Doug. Doug said Trump win and gold price. I don't know. And if Trump wins, what's he planning on doing? He's planning on lowering taxes, which puts more money into circulation. We go deeper in debt by a mile. Under his plan, we go over $1 trillion more in debt every year. And he, see, I don't want to get into the politics of it. He's a moron. Look, taxes are, we already don't collect enough taxes. Okay, here's problem number 1. We don't collect enough taxes as it is. So we have a $18 trillion GDP, and we only collect about $4 trillion in taxes. So 4 into 18 is like 20%-ish of taxes, right? Right, 4 divided by 18, 22%, okay. So we only collect 22% of our GDP in taxes, okay? Normal countries closer to 30. That's where our deficit is, okay? Because 8% of $18 trillion is your deficit, okay? So 18 times 0.08 is 1.45. So we'd be running $1 trillion surplus if we tax 30%. Now think about that, because you think you pay 30% taxes, and you probably do. But Donald Trump doesn't, and neither does Exxon, and neither does Chevron, and neither do the people who have huge money, neither does Bill Gates and Warren Buffett. Warren Buffett tells you he pays 12% tax. He makes $1 billion, $2 billion a year, and he's got $50 billion in the bank, and he pays 12% tax. That's why the government collects 22%. They don't collect 22% because they're doing you a favor. They collect 22% because the super rich people in this country pay no taxes, and that includes corporations who are citizens, thanks to the beloved, long, dear departed Scalia. Okay, corporations are people too. So when you talk about the top 1%, and Bernie Sanders does not make this clear, when you talk about the top 1%, you're talking about corporations and people, not just people. Everybody says, oh, I'm in the top 1%, or I'm close to the top 1%. And I think you have to make, the top 10% is about 135,000 or 160,000 family income. The top 1%, you're looking at, I believe, probably $300,000-$400,000 a year in income. That puts you in the top 1%. So you might be in the top 1%, you might be near the top 1%, you might think you're in the top 1%. Those are the guys that Bernie wants to tax. And that includes those corporations who make billions every year. And corporations in this country pay, they paid $400 billion in taxes last year. So that's $400 billion divided by $18 trillion. They paid what? No. 400 billion divided by 18,000 billion. Wow. They paid 2.2% of the GDP tax. So corporations paid 1/10 as much taxes as people do, even though wages are 1/3 of corporate income and profits are 15, 20% of corporate income. Okay, so logically, profit is at least half of wages. So in the very least, they should be paying more like half of what we pay. So corporations should be paying, obviously if they paid $400 billion, we paid $3.5 billion. People paid $3.5 billion trillion, and so they should have paid more like 1.7 trillion. So corporations paid about $1.2 trillion less than they should have. And again, there's your deficit. There's our entire budget deficit going back to 1970. If corporations paid what they used to pay in taxes, which was more than, corporations used to pay more in taxes than people did. If corporations continued to pay what they used to pay in the 70s, not only would we not have a national deficit, we'd have like a $10 to $20 trillion surplus in this country, in the government. And the government could basically say, and it'd be like Harvard, they'd have so much money that they could pretty much say, nobody has to pay taxes anymore, we can just live off the interest. That would be the situation if corporations paid the proper amount of taxes. And it still could be. It's not hopeless, you could still turn it around. But that's what's wrong with this whole frickin' country. So it's wrong with the entire planet, that we've let corporations take over the world. Anyway, what was I talking about? Trump, gold, yes. Oh, okay, it all comes together now. All right. So Trump, jackass, would want to make corporations even richer because he's a corporation. Anybody who's got $10 billion or even $2 billion or whatever the hell he has, it doesn't matter. Even the guy with $100 million, he's a corporation. I'm a freaking corporation. I'm Phil Stockwell. Okay, we have a company called PSW Investments LLC that controls Phil Stockwell, has pieces of other companies, blah blah blah. That's me. I'm a corporation. If you got money, you're a corporation. So when these rich guys talk about making taxing corporations less, they think even the CEOs of corporations are themselves corporations within the corporation, because they've got their own family trusts and diversified holdings and all this crap. Believe me, if you ever get, let's say $1 million, if you ever get $5 million, anybody who has $5 million knows exactly what I'm talking about. You sit down with your lawyers and your accountants and they set up a trust and they set up this and they have this and they tell you to move your money here and put it there and shove it there and blah, blah, blah. You know, it's a whole rigmarole and you end up forming like 25 different companies, all to pay the least amount of taxes you can. Okay, when you're a regular schlub who makes $100,000 a year, you pay you 35% to shut up, and there's no lawyers and accountants that are going to run in and help you, because 1% of what you make doesn't float their boat. So it's a whole different world for the rich people. Believe me, it's so different it would make you sick. I wish they would do a reality show where they would show people what it's actually like to be rich. It's just an incredible thing. And for rich people, they should show you what it's like to be poor. I think they should do a Survivor New York, where they just you take a bunch of rich people and you tell them they have to live like home. They take away all their money and all their cell phones and everything, make them homeless, no IDs, no nothing, and you say, boom, drop them in New York City and say, good luck. Show us how you're going to become a millionaire. Show everybody how it's done. Well, they'll be crying. They'll be in the middle of Manhattan screaming to get out. So that won't happen to poor people. If you take poor people and put them in country clubs and give them yachts and mansions and such, I don't think they'll be so stressed out. But the rich people going the other way would be very stressed out, I think. So Trump and gold. So anyway, Trump will run up the deficit tremendously, devalue the dollar. People lose faith in America. The economy collapses. Then gold goes up. Okay, so there's the final statement on that. The short story is gold will probably go up. In any case, gold goes up because, as I was saying this morning, though, the money supply, where was that? I was talking about that this morning. The money supply. Look at the supply of money. Here's how much money we had in 1984, and it was $293 billion of money. Now, I always question what this measurement means. You know, it's what they call the MZMV money stock. I think it's the amount of actual bills that are out floating around. But it doesn't matter. It's a conceptual thing. But in other words, so here in 1984, it was at 1.5. And here you go all the way out, 2009, so that's 25 years later. So 25 years later, it's at 1.9. So it's gone up 4 out of 1.5. So it's gone about 25% in 25 years. So basically, it's almost a straight line. It increases 1% a year for 25 years. Then, so if you don't think this is a big deal, 1% a year growth in the money supply. So the money supply grows at roughly 1/3 of the rate of GDP. And that makes sense because there's something called a money multiplier effect. And every dollar that is earned by a worker, by a wage earner, usually turns over in the economy 3.5 times. So when you give money to a poor person or to a regular worker, not top 10% people, but when you give money to people who spend it, who actually live with their, who take their paycheck and cash it and buy stuff and do stuff, because that's very true, right? Because I mean, you guys have a lot of money, right? I guarantee you have checks like sitting on the counter, you haven't cashed it, right? That doesn't happen to regular people. Regular people don't have checks that like accumulate, and they go to the bank like they go, oh, look at all these checks. I better go to the bank and cash in $20,000, $30,000 a check. That doesn't happen to poor people. Poor people get the check, or regular people, middle class people. They get a check, and most of us have gone through it, even if we're not there now. But you get a check, and you run to the bank with your check, and you want to immediately get the money because you have like bills to pay and things. It's just the whole life is so different. I got to tell you, it's very sad. I was just going through all this with. I was doing a workshop last weekend, so I'm very fresh in my mind. But another story. So 1% very, very steady, okay, for 25 years. Then all of a sudden, the Fed turns on the printing press. And we go from 1.9 to 2.3. So that's up 4 out of 1.9. So now we jump 25%, 25% in 25 years, 25% in 1 year, 25% again in another couple of years, and now we kind of fade out after another 10 or 15%. But on the whole, we've increased our money supply from 1.9 to 2.9, so that's roughly 50% increase in the money supply. Okay, you can't put that genie back in the bottle. The Fed printed the money, handed it out mostly to the banks, and the banks, banks and corporations got all the money. They were able to borrow money from the Fed and do stuff where they got 1% loans and things like that. So they've taken all that money's gone. None of it made it down to the consumer. It didn't trickle down like they told us it would. So all this money is out there, but it's sort of locked up in bank vaults mostly. Because what happens to the banks? They get the money from the Fed. They've got $1 trillion sitting in the vault, and they say, woo, thank God that financial crisis is over. Now I feel better. I got $1 trillion. Plus, at the same time, the Fed makes different reserve requirements, so the banks have to actually have, they're telling them that you have to have more reserves than you used to have. So the banks say, well, okay, we're just not going to loan it out. It's going to sit in the vault. So the banks have more money sitting in the vault, which the Fed gave them, and now how does that help the economy? It doesn't help the economy at all. There's no movement of that money. It doesn't change hands. That's why the velocity of money, which is using this scale here, fell from, now even here it was recessionary. This is all bad. The velocity of money is slowing and slowing and slowing for various reasons. But then in the crisis, it falls off a cliff from 2.2 to 1.8. The velocity of money drops 25%. Then it drops another 25% here. So before the crisis, you could see it coming, so the velocity of money dropped really precipitously. Then it comes back a little bit, and then because of the Bush stimulus here, and then boom, everything collapses. So Bush tried to fix it with the stimulus. It was stupid, but he did. He handed money. This is what's effective. Bush did that thing where he gave like $3,000 to everybody, taxpayers, and that works because, again, if you give money to people, they spend it. What did QE do? It didn't do that. It didn't give money to people. So, boom, everything collapsed. The people didn't get the money. The velocity of money kept coming down and down and down. So you have 50% more money, but you have 50% less velocity of money. So it doesn't help. In fact, it's worse because you added 50% more money, but that was added to the original supply of money. but the velocity of money dropped 50% on all money. So the original supply went down 50% and the new 50% went down 50%. So it completely wiped out anything the Fed did. That's why the economy's been flatlining. Even though they're putting trillions and trillions of dollars into the economy, they're putting it in the wrong place. But good luck. Good luck with the Fed trying to get the money back from the banks or whatever. The money eventually will get lent out. The banks will eventually start competing and wanting to make more money. They're going to start lending it eventually. They'll find some price rate at which they're going to be willing to lend the money. They'll start lending the money out. And when that money hits the streets, when that money goes into the hands of people who start spending it at 3.5 instead of, this is corporation spending too. But when people spend it at 3.5 and bring the average back up over 2, this is all inflation, baby. 1.4 to 2 is 50% inflation coming down the pike, just to normalize the money supply. To normalize the velocity of money. The supply is already out there. You can't put it away. So once they start spending this enhanced supply, it's going to go crazy. Things like, money is just going to be flying around like, what the hell happened? Where do people have all this money all of a sudden? It's going to come pouring out of the banks, and people are going to be able to start using it again. Infrastructure, not infrastructure. Hopefully the government will do some infrastructure spending. But it'll be very crazy inflation is going to hit us. In fact, almost hyperinflation down the road. Don't know when. We could be languishing like this for years. Look at Japan. Japan has the same situation for 20 years. So I'm not saying this is going to bounce tomorrow. I'm saying that eventually, though, it'll turn around because we're not Japan. We're America. We're going to have a different attitude about it. Okay, so Pat says, yes, looks good. I have some kind of gray mask over the image. Had to enlarge the window just to see the chat bar. Don't know what that means, Jim. Sorry. Is there some setting? Sorry, not my thing, Jim, but hopefully Greg knows. Yeah, the dollar kicked to the curb holding on the market. Oh, yeah, absolutely. The dollar went down nicely. It's down to around 97.07. So that's a half-point drop in the dollar. And, let me see. Okay. So it's a half-point drop in the dollar, and we have a flat market. So basically, if the dollar wasn't down, the market would be totally in the crapper right now. Would you recommend natural gas? I have been recommending natural gas. I love these questions so long after the fact. Yes, I still like natural gas, as I think I said at the beginning. I have been saying I like natural gas for a long, long time. Actually, I'm sorry, because I've been saying I like natural gas at 2. So I still like it at 2, but it's not at 2. It's at 185. I'm sorry, this natural gas, this isn't that contract. They only have the front month contract here. But I think the proper price for the front month contract is around $2, which would be about $2.20 or $2.10 on the longs. I think maybe we should get over 2. I think eventually we'll be back to $2.50, maybe by the end of the year. Maybe in the summer, maybe at the end of the year, we should be $2.50. I think $2.20 though is a good time to take the money and run on this particular contract. And certainly, and frankly, from 177, you get to $2. That's $2,500 per contract. You should be really freaking happy. So using this contract at 177, I'd put a stop at 175. You're going to risk losing $250 per contract, but your upside is $2,300 from here. So so basically, I would play that with tight stops just to hopefully 175 holds here and we start taking off. Where were the questions? Right. Coca-Cola. Okay. Just say no, Deanna. I'm not sure what that means. CVX. Div is driving the price. Investors are desperate for yield. That's bullshit, though. There's a lot of stocks that pay 4% that you don't have to pay up for Chevron for. Okay, it's not safe. Most people who buy dividend stocks aren't playing options. We're smarter than most people, but most people don't secure their dividends with options. And so they're risking the downside. So what's it going to go into a stock that has a 4% dividend if the downside is 10%? That's 2 years worth of dividends. Now you have nothing. There's no way that's just not a stock I would be putting in for dividends. I wouldn't even be comfortable trying to hedge that because it's just, oil is $35, $38 right now. And $38 is too high. It should be shorted at 38. But oil is 38, and it was 60. And when it was 60, Chevron barely was worth what it is now. Barely. Now there's no way in hell you could justify this price. Not even beginning to get close. Craig says, I came in a few minutes late. Did you look at the one? Oh, no, I forgot all about it, Craig. Thanks. EIA report. Good call. EIA. This is the weekly petroleum status report. Oh, that's why I should have put that in. Petroleum. Oh. Petroleum status report. There it is. Now, we looked at oil earlier, and what I said is I think that you'll find that the oil, what? Well, man. I think that the drawdown you're seeing in gasoline is really a result of refineries coming offline because they're into refinery maintenance season in the spring. They do their refinery maintenance, and they do that, and they also switch their fuel blends from winter fuels to summer fuels. So in the course of doing all that, they take down little reactors, whatever those things are that they make stuff in, and they clean out the pipes, and they do the maintenance, and they fix all the screws, and they put in new stuff. So that's what they do this time of year. And so, and they kind of coordinated, all the different major refineries around, try to kind of coordinate it so they don't take more than maybe 10% of their stuff offline at a time. Otherwise we'd have huge production headaches. Not that it matters now with all the storage, but that's the weird thing too. When you have this much storage, it doesn't matter if you use some of it. Everybody acts like if we have a drawer in inventory, that's a big change in oil. Okay. It's like this. It's like I go to the bank sometimes. I'll take every once in a while I'll get a bunch of 20s. I'll take out if they give me $500 worth of 20s, and I keep that for the kids. Not because if they need money, they always need money. They're going to the mall. They're going out with friends. They're going to the movies. Blah 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 blah. So when I've got a stack of 2020s, not 2020. How many 20s? Yeah, 520, so it's 2520. So it's when I have a stack of 2520s at the beginning of the month, and they ask for some money, I'm like, yeah, sure, here you go. Big pile, who cares? It doesn't affect anything, right? But when you get closer to the end of the month, when the pile is down, when my supply of 20s is low, and now they start asking for 20s, I'm like, wait a minute. Here's a good way for me to keep track of how much money I've been giving them, because then I'm like, wait a minute. It's like you got a week to go in the month, I've already gone through my stack practically. So I'm like, you really need this money? I start getting a little more. That's when I start worrying about the value of the stack. But I don't worry about it when it's full. And believe me, our refining capacity is completely full right now. So whether or not we have a drawer of 3 million barrels out of our 1 billion, I'm sorry, not 1 billion, 2 billion barrels of inventory. See this total here? That is 2 billion barrels of oil sitting in inventory. That is not 2, it's 2.04. So it's 125 plus 40 is 165 million more barrels of oil and petroleum products. 165 million more barrels than we had at this time last year. Now, there are 52 weeks in a year, so we divide that. We divide the 160-something by 52 weeks, and we get 3 million extra barrels a week. That's been our average bill for the past year. 3 million more barrels, and not oil, but all product total. We have been every week, on the average, adding 3 million barrels to our inventory. So who the hell cares if in any one given week we have a $3 million draw, is that going to make even the tiniest dent in what we've got? Yet the market will freak out like it did today, and oil goes flying up on the stupidest thing. It's pointless. So keep that in mind when we talk about this stuff. Sorry about that, guys. The worst thing about crashing is that I can't see any of the questions you guys had. So wherever I left off, I have no idea what was said after that because it all looks like brand new chat now. All right, so if you do have questions, feel free to re-ask them. Let's see. Nope, store. That was do not touch your computer, do not turn off, blah, blah, blah. So unfortunately, that's what happened. Oh, there it is. Screen sharing. Java. I blame the Java. There's one thing too many for this damn computer. All right. Hopefully we're back. Oh, wait. Now, hopefully we're back on. All right. Sorry about that, guys. Where was I? I was making such an excellent point on the EI. Anyway, all right, so it's all bullshit. That was my point. It's all bullshit. The only thing that matters here is this. We had 1.8 billion barrels here, and here we have 2.04 billion barrels. Therefore, 125 plus 40, 165 billion barrels were added to inventory in the past 52 weeks. That's 3 billion barrels every single week. Too much oil. How is that going to be fixed? How much oil do we import? We import 7.6. Why are we importing 7.6? It went up. We are importing 7.6 billion barrels a week. No, millions. Sorry, millions. We import 7.6 million barrels per day. Per day. Okay, we're exporting. Look how much we're exporting. We're exporting 2 million barrels a day of petroleum products, mostly gasoline that we send out of the country. So what are we going to do? Are we going to cut half our imports? Or are we going to cut 1/3 of our production? Where's our domestic production? Well, obviously, if you take the amount of imports, and you take the amount of crude input to refinery, that's another 8 million. So yes, basically they're the same number. It's roughly 7.5, 8 million barrels a day of domestic production and imports. So either both of them fall by 25% or one of them falls by 50%. But that's the only way you're going to get stability because we're 3 million barrels a day too much. So 15 million barrels. Okay, the input to refineries is 15.8 million barrels, but we're adding 3 million a week to imports. So we're making too much. No, I'm sorry, not 3 million. It's 3 divided by 7. Okay, it's 500,000. That's what we have to cut down. Let's do the math again. 500,000 out of 15 million barrels total that are being produced between the import and whatever. If we cut down 500,000, that's like 3 million a week. That'll cut our surplus. All right. So out of 15, so still 3. How much is that? If you're doing 15 million a day and you have to cut half, that's 1/15 is 6%, 3%. That's not that bad. I mean, it has to happen. We have to cut down our production by 3%. Or a combination of production cuts and export cuts. But we haven't done it. We've had no history of doing it whatsoever. Look at the product supplied. We're supplying the same amount of products we supplied last year. That's the key. What the hell is that? Oh, something was buzzing. I had no idea what it was. All right. So we're supplying the same amount of product we supplied last year in oil. Input to refineries. The input to refineries is actually gone up a little bit. The production is the same. So so here's what we want to see, whether it was production coming offline. We haven't seen a lot of production coming offline. So mostly it's just kind of a quirk that there is a draw on gasoline. There's not really a reason. So we increase. So in other words, the oil inventories increased by 3.9, but we had a 4.5 million barrel draw in gasoline inventories. There's nothing here that makes it clear why that happened. Okay, so I couldn't tell you what was going on there. It's very hard to see. But the weird thing is, like, look, we have the same amount that we're producing, but we were producing it for $49 last year. Now it's $35, $14 less, so almost 30% less than it was last year. Same amount, same everything else, same stuff coming in, everything else, just 30% less. Now at the pump, you're down 25%. You're down like 60 cents. So from 48 to 84 is pretty much 60 cents out of $2.40. So that's roughly 25% drop in price on a 30% drop in the amount of oil. So the gasoline is doing better than oil, but not that great. But still, it's good for the refineries because they're making a better spread because the price of oil dropped faster than the price of gasoline. That's good for them. All right, but on the whole, there's nothing bullish about this report and nothing that supports higher oil prices. I mean, if anything, it's just terrific that we are building 3 million barrels a week and there's no sign of stopping. You know, and I'm not talking just the oil. It's net inventory. This is the oil, the gasoline. So everything you use compared to everything you have, you're not using. Whatever you don't use gets added to inventory. 3 million barrels a week too much. That's a tough nut to crack. It's a long time before that number changes. But again, it's nice to have that number in our head because now we know what to watch. You want to see an improvement of that net number. It's got to start coming down. It's got to start coming down significantly. A single month or a single week's draw is never going to tell you the story. So the reactions you get on something like this, which we shorted into, that's why we're shorting into it. All right, so short story. Short answer. I have a question that is no longer here. Okay. Yeah, I blame Windows. I blame everything. I'm so mad at technology right now. It's just incredible. You know what I should do? I should do this thing on the iPad because on the iPad always works. Always works. I've never been on my iPad and said, "Oh, it crashed." That just never happens. Doesn't crash, it doesn't update me. You know, it wants to update, it puts a little note in there. So, would you like to update now, please? And you put it aside, it updates, and it's fine. Maybe someone in the chat can explain to me. I was looking at the LADU trade. That's an ultra long on the whatchamacallits. But again, I can't see your old comments, so you have to re-ask the questions. But LADU is the ultra long on the biotech. And we got an aggressive stance on that, and it's moving along. It's not the best, but it's going ahead, and we're pretty confident in that trade. It's a good spread. Let's see. Oh, come with you. What's the advantage of using 3 legs instead of just using the 9-strike put? In LADU, what was that spread? What's that portfolio look like? Whoop. Is that the options opportunity portfolio? I think it's in this one too. It's in the short-term portfolio too. Yeah. We have the, what's the reason? Well, first of all, if we just sold the puts, well, I'm not sure what the 9 puts are. Let's take a look at if we just sold the $9 puts. Probably isn't that far apart. LABU. So if we just sold the September $9 puts, those things are, let's say, $4, okay? So 4 is the most you can make on the trade at 9. At 9 or higher. Anything else, you're going to be giving some of the money back. Your break even on that trade is $5 because you sold it for 4, so your break even is 5. That's actually a really good price. Now, how did we construct the trade? We constructed the trade where we're going to have less margin for one thing because we only filmed the $5 put, so we're going to have half as much margin practically. We constructed the trade where this is a net zero cost to us. See how 3,700 minus 22 is 15 or something like that, and then minus 350 is 1350 is $150. So the cost on this spread is $150 cash out of pocket. And what's our upside? Our upside is $4,000. It's the same money. So it is the same money. You're right about that. But the difference is, aside from the fact that this uses less margin, the difference is that the put, if it goes against you, you pretty much get screwed, right? Because if it goes against you, it goes the wrong way, you're going to have to pay off the put to get out. With the spread, we own the $5 call. The $9 calls, the short ones, will lose value faster than the $5 calls that are in the money. We can probably have an easier time adjusting the spread. Plus, it could drop. So in other words, it could drop to $7, and we're still going to get paid because at $7, we have a net zero cost pretty much, and we'll collect $2,000. And also on the short puts, you'll collect $2,000 too. So honestly, the main advantage is just the fact that you've got less margin, a little bit more flexibility because you actually own something. You own those $5 calls. All right, but it's not, in this particular case, it's not a big deal. Habitually, we do it because it usually is a better deal. That's just a tremendous amount of premium on the September $9 puts. I mean, when do you have a put that sells for like 40% or 45% of the price of the stock? That's pretty extreme. Which frankly, I think it actually is a great sale. I mean, it's a good catch by you because you're right. Logically, it's just as good. It's just a question of whether or not you care about having the extra margin, which isn't, is honestly not a huge consideration. Oh no, what is this? Why slow now? So the markets are picking up nicely, right? Moving back up. The dollar's even coming back, so everybody's happy about everything. Gasoline all the way up at 146. Where's our natural gas? Natural gas is hanging out here near the top. Oil almost touching 38 again. Real tempting short here, but we had 38.50 yesterday, so we kind of would like to see 38.50 to take a real short on that. And the indexes, though, holding up nicely. And the Nikkei, look at that recovery. 300 points on the Nikkei today. So everything's coming up roses. I imagine somebody said something somewhere. I haven't been keeping track since we started the meeting. But somebody probably said something about something. All right. What's even your 3 lists, right? Walmart, 62.50 calls from the Butterfly portfolio was exercised today. I know we can just buy back the stock, but what's next? For Walmart? Well, you're short Walmart now. You don't want to be short Walmart. No, I see. That's the thing. It broke up, and you sold those calls. So somebody took the calls from you, took the stock from you, and left you short at the strike, which I forget what you just said. It was 62.50. So you're short Walmart at 62.50 essentially, but you have the cash that the guy paid you for the stock. You have the cash you collected for the short puts, plus you have now the cash you were paid for the stock that you didn't own, but that left you short because the person took the stock from you that you didn't actually own. So it wasn't what you meant to do. I would close it back out. Now, as to a new position, I think probably this is a good range where we are now. You mean the 67.50, 72.50 range. So I wouldn't be aggressive, though. I would just go ahead and sell the, let's take a look at the Butterfly portfolio. Oh, my God. How is it? Oh, because we're so bullish. God, I keep forgetting that we're not. It's so weird. We're not running this like a butterfly portfolio at the moment. We're just running it like it's an aggressively bullish portfolio because we took apart all of our butterfly plays, and I really gotta deal with this tomorrow. I talked about this like 5 times already. I'll just mention it right now. What happened is when the market was really low, because this is such a well-hedged portfolio, we didn't have much damage when the market was down at 1850 again. But since we firmly believed that 1850 was going to be the bottom of the range, we aggressively went bullish on the butterfly portfolio. We picked apart, we pulled the wings off. We took away all the covers and basically and moved ourselves and flipped all the positions. Most of the positions are generally just bullish positions now. And we did it at such the right time that we gained like 40%, from 80-something percent to 126% in a couple of months. So we gained 40%. This portfolio obviously is never supposed to do that. We just had very good timing. That's not what this portfolio is about, though. So I really have to make some drastic changes coming into expirations, which is what, next week, right? Where are we? Yeah, next Friday. So we have to make some drastic changes to the butterfly portfolio because it's not, and now it's not hedged at all. It's just bullish. That's crazy. I'm sorry. I mean, there's no way we should be making that kind of money. But anyway, back to Walmart. See, here, Walmart's another example, right? It's just a bullish play. Oh no, this is actually one that is hedged. We sold we sold the puts. Wait a minute, what are you talking about then? We don't have any short calls. The March 6250 call. We don't have any short calls. We got rid of those ages ago. We have the 6250 puts. But we went aggressively bullish. When Walmart was down, this is back from 115. I imagine that was when Walmart was way low. We took that dip. Oops, sorry. But anyway, if you sold the calls, either way though, if you did sell the calls, it's not a big deal. I would then flip it to the puts and calls. So let's see, the 6250 calls. I mean, that position's been that way for ages. We haven't touched it. Trade Walmart WMT. And maybe it was an error when I put it in. I got to go back and look at that. But even if it was an error when we put it in, we kept it because we wanted to be bullish. We came, at some point we decided we wanted to be bullish. These puts are gone. That's really worth having. All right. So 6250 calls are now $5. Okay. You own Walmart. So if you sold these calls, so what happens effectively if somebody says, okay, I paid you $5 for the right to buy Walmart from you, or not $5, whatever they paid you at the time, but I paid you for the right to buy Walmart for $62.50. So let's say they paid you $1. Let's say you sold them for $1. Well, what are we selling them for? Oh no, we didn't have those calls. That's I can't tell you. Let's say we sold them for $1. Okay, so the guy's like, okay, I paid you $1 for the right to buy Walmart from you for $62.50, and now Walmart's at $67.50. I want my Walmart. So he then gives you $62.50 cash. It's in your portfolio. You then are forced to give him his Walmart shares. Okay? You don't own Walmart, so you had to go short Walmart and give him the shares. So you had to borrow Walmart stock, give him the shares. That's how it works. Now, what you need to do though, because you're short Walmart, is you want to just close that out, which means take the money that you had in the bank and take it. You're going to take a $5 loss, less than $1 you had from the original contract, so you're going to be down $4. And you still have the rest of the position, presumably. So what you want to do then is just roll it out to April, and basically, let's say we sell the 67.50 puts and calls for $3. So you don't recover all of it. It's like a little bit more than $3. So let's say it's $3. So you sell the 67.50 puts and calls, which are right on the money, for $3. And now you sold $3 more premium in another month. And you're not going to win every month, but when you do get a win, it could be a very good win, and you don't usually have to roll so drastically. So if it stays more or less in its range, you'll be able to work out of this pretty quickly. But again, like anything else, it has its ups and downs. It's going to go sometimes in your way, sometimes against you. But over the course of time, if you're selling $3 every single month of premium, and that is premium. Walmart's at $67.50. You're taking a bet of $1.50 from him, and you're taking a bet of $1.50 from him that Walmart isn't at $67.50. But if Walmart is at $67.50, if it does flatline, you make $3. And you're going to take that trade 12 times a year. That's $36. And as long as you keep doing these rolls where you get yourself back to a position where you can make money, you really, all you have to do is be lucky a couple of times and you make some good money. I'm not saying you're going to make $36. We're going to sell $36 worth of premium. We'll pay back $30 worth of premium maybe on ones that go against us. But the $6 we keep is a lot of money, especially compared to what we lay out on the trade. That's how those things work. All right, so it's not a big deal. You just take the loss and you move on and sell the next month. Some months you win, some months you lose. But the bottom line is we got here. We got to this 126% mostly by just grinding it out. Because we sell premium, we sell it and we sell it and we sell. This is the whole be the house thing is in this portfolio. It's all we do in this portfolio is sell premium, except at the moment where we went very bullish because all of our premium plays gave us a very low base. All of our premium selling gave us such low bases that we were very happy to take a bullish stance. But now I can't. I mean, this is too much money, so we have to do something about that. That is crazy cash. All right. Is the end near? I don't think the end is near, frankly. I mean, my premise for the overall market is that the central banks do have more firepower in them. I think Draghi, well, I thought Draghi was going to disappoint us tomorrow, but somebody said something that boosted the markets. So I don't know what it was. Hang on. Let's take a quick look at the news. Dunkin' Donuts in Mexico. AK Steel outperformance will not last. Airlines under scrutiny for baggage fees. Yay, I like that. Juniper and Lenovo, who cares? GE, oil and gas, who cares? Franklin Resources, who cares? CBS gains on Wells Fargo upgrade. The split. Chevron surges after finally turning the corner, according to that analyst we were talking about. The loonie shoots higher as the the Bank of Canada stayed on hold, and the Canadian dollar went up and then helped push the U.S. dollar down. That's one thing that happened about 1 o'clock. And the dollar going down, of course, is always good for a little market pop. Moody's likes Walmart, so Moody's just talked about Walmart positively today. McDonald's tests their breakfast menu. What? It's a done deal, isn't it? McDonald's tests marketing the full breakfast. If they take that away, my brother's going to have a fit. He loves that breakfast menu. MGM Resorts keeps employees in Macau. Nothing. I see nothing. I'm going back all the way to noon. Nothing. Chesapeake Energy moves higher on an asset sale. Google and Facebook are killing everybody in the social media spaces. Amazon, UPS and FedEx are being held up because everybody's worried Amazon's going to compete with them. Good luck. Good luck to Amazon. Jeez. That is a tough business, man. They're going to start back from scratch and start competing? No, I don't think so. Well, they don't have to compete, really. They actually could start, but they just have to get into their own business and they'll be in good shape. Under Armour gets into 3D gaming. Okay, well, that's pointless. All right, great. Nothing. All right. So it's all up to Draghi tomorrow. Draghi's almost. I was under the impression Draghi was going to be disappointing tomorrow, and there'll be a little temper tantrum in Europe. It'll probably spread to us, and everybody will go down a bit, and then we'll bottom out, though. But you know what? That's perfect because bottoming out tomorrow is the day they sell the 30-year notes, and they want to have people buy the 30-year notes for good prices. Oh, and then we're going to have that auction win. Does anyone know? Okay. So yes, I was talking about EI. Hopefully we're done with that. And now we're good. Okay, cool. All right, great. All right, so we looked at a couple of portfolios. The Butterfly portfolio has too much money, that's for sure. The 5% portfolio is going to be iffy, I bet. Ow, man, are you kidding me? 16.3. Lost like $3,000 today. I don't know why. Oh, lumber liquidators. That's what. Yeah, we took a big hit on lumber liquidators, obviously. It went so far down. All right, that explains that. What else could be giving us trouble? Well, we have our shorts that are going to be hitting us right now. TLT went against us. No, it didn't. Actually, 107. No, it went our way, actually. TLT's down 107. Actually, it's 128 is our target. That's where we want it. What is this? Long puts. TLT. Oh, yeah, long puts. Okay. That's not going to hit, obviously. It's very unlikely. All right, so that portfolio is fine, though. It's back on track, and day-to-day fluctuations are not that important. The long-term portfolio also made way too much money. Let's see if it still has it. 67. It was 74. Oh, my God. You know how much 7% is in this portfolio? It's like $30,000. Again, I don't know why. It's changing the VIX. It's this or that. Who knows? It's too many things to go over. I mean, this is getting to be a large portfolio. I mean, also lumber liquidators, but I mean, that isn't that big of a trade. EXPE? What is this? Why do we have two short puts? That's weird. I don't remember that trade. All right, well, this we got to fix. That's an easy fix, but that's got to be fixed. I mean, I don't understand that. I like Expedia. I don't know why they like that, but clearly, you're going to have to roll that to something else. Anyway, I don't see anything particularly nasty that's happening here, so I don't know why we lost value. But on the other hand, you know what? When I saw it was up 74%, I didn't take that seriously either, because it was ridiculously high. So that was as much of an aberration as being up 67% is being down 7% from that point. But anyway, on the whole, it's way ahead of schedule because we're only trying to make. Our goal is to make at least 20% and hopefully 30% in a year, and we've had this thing for. Well, no, actually, it's on track. 2013, so it's all 2013, all 2015. So we had 2 years. So we are right. We're right about where we should be. 67% in a little bit over 2 years is pretty much on the high end of expectations on this portfolio. So that's going okay. All right, and again, all these portfolios are the same. All cash, all cash. Okay, or we're using margin, of course, but cash. There's huge amounts of cash in these portfolios because we still don't trust the markets. All right, and in the short-term portfolio, we just bumped up our hedges. Well, that's worth talking about, right? I sent out alerts on both of these, not top trade alerts, but regular alerts to our members. Here it is. Wednesday. So we were talking about the short-term portfolio, wherever it may be. There it is. It's so nice and small now. So what do we do with the short-term portfolio? With TZA, we took the 52 calls and we rolled those down to so we cashed them for $3. Then we bought the July 48.60 bull call spreads for $3.10. So we leave. So now here's the beginning position. So TZA, see, the thing about it is, see this, we bought it for $6, we sold these for $4.50, right? These are still worth $3 or $3.19, whatever. But these are still worth $3. We paid $1.50. We can take 3 out. This is where people get very confused about this stuff. If I don't think TZA is getting to 57, then I can cash this for 3 and I'm up 100% net. The thing is now I have a risk, though, of this short trade. But if this works out, I'm up 100% on that trade, even though it went against me. Even though it went drastically against me, because that went from 6 to 3. All right? But that's not the safest thing to do. So instead what we're doing is, because it's an insurance play, I'm taking the same money we invested here, the same $1.50, which is about $7,500. So we're taking the same $1.50 we had here. Now it's $15,000 instead of $7,500. And now I'm putting that money into a longer, better spread. So this was a $5 spread that lasted until April. and we're taking the money that we made, that we didn't really make it yet, but it's there. So we're rescuing that $3 since it's there, and we're taking that $15,000 and we're buying this spread, the July 48.60 spread. Now, what was our old spread? Our old spread is 52.57. Now we're getting the 48.60 spread. So in other words, I've now got $12 covering this 57, whereas before I had $3 covering this 57. In other words, the only way this 57 can get paid is if I'm if we're $12 in the money on the other spread. Or not 12, I'm sorry, be minus 3, 9. We'd be $9 in the money before we have to pay that caller a penny, and then we obviously could roll the call or do something else. As it is, though, I think I said stops. And why did I say stops? Not because I'm worried about the trade. I said stops because this is supposed to be a hedge on our main portfolio. So it's not much of a hedge if we're playing it against the short calls. So we put a stop on 20 out of 50 at $3. They're $2 now. So if they go up 50%, we're going to take 20 off the table. And then if it goes up another $1 from there, we're going to take 20 more off the table. How much would that cost us? $6,000 and $8,000. So we'll spend $14,000 to get out of this position if we have to. Only if we have to. Hopefully we'll spend nothing. Hopefully it'll stay below. And all we end up with then would be the July spread, which is just cheap insurance then. Then we've got, and see what we're doing. We're moving our insurance out in time and lower in strike, so we stay at the money with our insurance. We're picking up the 48 calls. It said 49.52. So we're staying at the money. We only adjusted our original $1.50 per spread, and now we're $1.50 in the money in our July position. So you see how that works? We're taking the unrealized gain of the April position, and we're realizing it because we're saying, let's get to lock in that 3 while we can before it completely decays away on us. All right, because the S&P wasn't as weak as we thought. It's not the S&P, sorry, it's the Russell. The Russell was not as weak as we thought it would be. And by the way, this wasn't our bet. Our bet was in the long-term portfolio that everything would be great, and the long-term portfolio made a fortune. But our bet in the short-term portfolio is a hedge. So in case the Russell went down, which it didn't, we had an insurance play that would have paid us off the money. Now we're taking the same insurance payment that we made in February, and instead of just protecting us for the next 45 days, we're now adding 90 more days to the protection. And we're widening the spread from 52.57 to 48.60, and all with the same money. So this is what we do, and this is why, and it's fine to put a little bit more cash into the trades because it's insurance, okay? It's the money we made, and here we must have made $30,000-$40,000. The money that we made on the bullish plays is being funneled in part into adding more and more protection. So the more we make, the more we hedge. And so the higher we go, when we're at the very, very top of the market, and this is how come we did so well, because we followed this pattern all the time. When we were at the very top of the market at 2,100, and I said, "Oh my God, I can't take it anymore," when we had to cash out, and we whittled down our positions at 2,100 on the S&P. At the same time as we were doing that, though, we had these gigantic hedges, and so when we start cashing out our longs, and we're left with just the gigantic hedges because we make them bigger and bigger and bigger as the market goes higher and higher. As the market moves against our short hedges, we make them bigger because they're cheap to make. I would not have wanted to spend the money it would have cost to buy the July 48.60 bull call spread on TZA back when we started this trade only a couple of weeks ago. But now we're getting that trade for free because we're taking the money we made on this call, and again, we didn't make the money, but the net of the spread is more. We're taking this money out and buying the July spread, and now the July spread, by the quirks of options decay, cover the short Aprils. Can you get burned? Yeah, you can get burned because there's a gigantic meltdown in the market. The way you get burned is that is that you may barely escape even, or you might even lose money on your hedge, and then and then you're not covering the losses on your long. So yeah, you can lose money. It's a little bit dangerous, but you have to use your brains and say, hey, it's a risk worth taking in this case, because obviously the markets aren't flying down on us. So we're going to take a little bit of a chance. We're going to build this big spread. We're going to put stops on those short calls to make sure we don't get killed. But even if we do spend $14,000 to deconstruct this trade, and by the way, it's $10,000 now. So we're not talking about spending, I'd have to spend $10,000 to close it today. We're talking about spending $14,000 to take 40 of these off the table. So even if I do end up spending an extra $4,000 and taking 40 of these guys down off the table, I'm still going to have some tremendous coverage. I'm going to have 50 times 12 is $60,000 of coverage. So it puts that spend in context. But the idea is we want this to be a hedge still, so we trade it differently than if it was just a trade. So that was one adjustment. So there's one way we just got a lot more aggressive, basically, on the way down. And we also adjusted SDS. We brought back the March calls, the short calls, and now we have naked June 20 puts. 20 calls, sorry. So SDS, we buy back the March short calls. They're only a nickel or 4 cents. And now we just have these June 20 calls long. They've lost money, but not much, because really we made 65 cents here and we lost $1.20 here. So we lost about 60 cents on this trade so far, but not really, though, because we also sold these short calls. Oh, I'm sorry, we're buying back both of these. Oh, well, actually, we're doing well. We sold $1.70 here. We're only spending like 20 cents to buying back. So we made $1.50 here. We didn't lose $1.50. We're actually ahead on this trade overall. Oh, in fact, you can see it here, because it's minus 58, plus 33, plus 43. That's 7, and 7 is 8. So let's say 70. So we're actually up about $2,000 on this hedge, because we aggressively shorted here. And again, it's the same thing, though, right? We rolled that back to June. We left the open 27s. We added the 22s. And because we said we think it's going to be more bullish than this. And it was. And that's right. It's confusing. It's an ultra short. So we thought the S&P would be more bullish. Therefore, we thought that this would go down below this number, and it did. And that's where we are. But now, today, ahead of Draghi, I don't want to take this chance anymore, because I think we may have a 1 or 2% sell-off in the next couple of days. And if we do, I want to err on the side of caution, protecting the long-term portfolio. That's what the short-term portfolio does, is it protects the long-term portfolio. All right? So never forget that about the short-term portfolio. It's not in a vacuum, okay? We're always going to err on the side of being short. Because frankly, if the short-term portfolio is going up, when the long-term portfolio is going up, we're doing something wrong. They're not really supposed to do that. The way we made all our gigantic, huge amounts of money in the short-term portfolio is, like I said, what we do in the short-term portfolio is, as the long-term portfolio is going up, the short-term portfolio, these hedges in particular, would get cheaper and cheaper and cheaper, and we'd buy more and more and more until we had like 100. Now we have 50. So we have like 100 or more than 100, of each. Like we'd have 100 SQQs, 100 TZA, 100 SDSs. We had the DXDs and the Dow Ultra Shorts too. We just kept adding more and more and more puts as each index got higher and higher and higher. And then when we would get to the top, and the short-term portfolio being short-term, we would cash in all of our longs, because we were said, oh, it's high enough. Let's take the money and run on this stuff. Because all we have to do to become much shorter in our paired portfolios is cash out the longs in the short-term portfolio. That leaves us extremely bearish in this portfolio, which then gives us extreme protection to the long-term portfolio. That's how we balance things out. And it's a special purpose. And by the way, in Thinkorswim it's easy. In Thinkorswim it's very easy to flip between portfolios. There's a thing up here. And if you have multiple accounts, you switch from one account to the other. And you can keep different portfolios in different accounts. So that's why I prefer that, because I like to know what I'm working on. I like to know if I have long-term or short-term positions. But if you can't do that, you could have them all in one place. You just have to keep track of it. You just have to remember why you've got certain positions. But another way, by the way, that's also one of the reasons I have that habit where I only buy like leaps. I only buy January, either 2017 or 2018. So I always go to January, even if they have Marches or Junes, because that way I'm not confused. Okay, so that way, if I am looking at a single portfolio with all my stuff in one place, I know that any position I see that's 2017 or 2018 is a long-term portfolio position for me, and any position that's March, April, May, June, whatever, that's a short-term position for me. That's the difference right there. So I visually, very immediately can sort these things out, even if my broker's not helping me. All right, so, 2:30 already. All right, let's see if we can get the last couple of questions in. No, not really any questions. 10-year auction, lowest bid to cover. I knew it went bad. Okay, so there's a bad auction. Whether or not, whatever it went out for, the bottom line is it didn't go well. And if it doesn't go well, people get nervous. So let's see the hourly, and that's not so bad. But here we were. Okay, so here's the auction. They announced the auction here. But here is where the auction actually ended. So the insiders know already before 1 o'clock that the auction didn't go well. Here's where the general public finds out it didn't go well. It spikes down, and then it recovers because this is what the professionals already traded it to. So it went here. But still, as the news spreads and as more and more people become aware of a bad auction, it goes down and down and down like that. And it's not TLT, that's the 10-year note rate. Not the rate, I'm sorry, it's the 10-year note value. And CL squeezed into the close, and Rex says audio. Hopefully that got better, Rex. I don't know. I'm gonna see how oil's doing. 38.50. Oh, that is where I said to short it. Damn it! I wish I caught that. Anyway, so 38.50 is pretty much where I thought the top would be. Again, you can't short oil into the weekend. It's just so freaking dangerous. It's tempting, but it's dangerous. Gasoline too. I kind of like gasoline short up here too, but they're both just so dangerous to short at these positions. But around here, well, it's not 38.50 anymore. At 38.50, I certainly like it short, and that was our logic when we were talking about it before. This is a good shorting spot, and we'll see what happens. Basically, we're just going to sit back and watch it. All right. So unfortunately, nothing exciting to play in the futures today, but I do think tomorrow could be a big down day, and if I had to pick something, I would go with the Nikkei at 16,750. What's this line? 18? Oh, 16.8. 16.8. At 16.8, I would stop out, but I would take this short at 16,750. But frankly, I mean, we've got enough shorts, and I'm not really that into it. All righty. Let's see. One more question, I guess. Where do you like NG for quick in and out longs? Okay, like I said, I don't like NG the front month. NG, but if you're going to trade at 175 line, at the moment should hold. If it doesn't hold, then you go to the 170 line. But with the nickel lines, basically. So I play for like a bounce off the nickel lines, but don't ride them down. You want to get right the hell out. If those nickel lines don't hold, get out, wait for the next one to be tested, or wait for this one to cross back over. And if you're lucky, you'll catch a 2 or 3 cent move or a 5 cent move, and that's a few $100. All right, and if you're unlucky, you'll take a $50 loss and get the hell out. That's the way I would play it right now. We have the longer term they're not longer term anymore. We have the next month contracts, the Mays. These are the Aprils that are currently trading. But we're hoping in the next 30 days we get a 20-cent pop at least in natural gas. It's kind of looking good, but I wouldn't say I'm hugely comfortable with it. And frankly, if it doesn't do it now, I'm not even sure how I feel about sticking with it. I think we're just going to rely on our UNG trade to pay off by the end of the year instead of even. And so I'm going to basically be taking it off my radar in the future. If it doesn't make a move next month, with the beginning of these exports has finally started, and if the story doesn't catch on and people don't get into it, then I'm done with that trade. All righty. So again, 38.50 short on oil. I like that one, except that again, very, very dangerous into the weekend. Okay, but this is a big 5% pop at 38.50. It's definitely a great rejection line. The Nikkei at 16,750 is another one I like for short over, into the overnights, and if you're lucky, you'll catch a nice down move there because other than the dollar dropping, there's no reason the Nikkei should be back up. Okay? And then when Draghi does, again, the dollar's dropping. If Draghi eases at all, the dollar's going to pop back up. If Draghi doesn't ease, the markets are going to go into free fall because then people are going to freak out because they need money. Europe is a mess. The reason why I don't think Draghi's going to ease, though, or not ease much, he's going to have to do something, but he can't do much. And because if he does much, first of all, Germany is completely fed up with it. They don't want any more easing or any more QE at all. Europe, England is like, screw you, we're not paying for your problems in Europe. We're fine, and we want to move on. And this is what the British exit thing is all about. They're like, we're fine. The Queen, nobody's even making a big deal out of this. The Queen this weekend, and I know that people think it doesn't matter, but it does matter because it's where the people's heads are at. The Queen said, I don't think this EU thing is working out. Okay, she basically said that's it. And now, when the Queen says something, I know it seems weird in America, but people in England really care about it. Like they act like they don't care, but there's this sort of embedded thing with the older folks in England where the Queen matters. And if she feels some way, it's kind of like if Kim Kardashian feels that way. You might say, oh, that's stupid. Who would follow Kim Kardashian? But imagine Kim Kardashian without all the scandals having an opinion, right? And we don't really have anyone like that who we actually care what they think. Maybe I guess Warren Buffett. It's almost like, yeah, I guess this guy, I mean, it feels